Joining us here in the studio to talk a little bit more about the banking sector is John Aiken, who handles the research on banks for Barclays. You've been kind enough to join us a few times recently. I mean, just looking at those stock drops, what's your first reaction to that, John?
Well, I think my visit here last week was a little bit too much of a understatement in terms of what we're talking about.
Unbelievable.
But it's when you take a look at what's happened to the world just since Friday morning, with the Bank of Canada announcing the rate cut, a couple of regulatory changes, and then over the weekend, the Fed going to an unprecedented level in terms of where the rates are going. This not only has negative implications for the banks in terms of their earnings from net interest margin compression, but also the broader economy. The central banks worldwide are seeing significant slowdown in terms of growth, which is what is leading to these measures. What we have to figure out, though, is exactly how bad is this impact going to be in the economy, and this is the uncertainty that we're seeing being priced into the stocks today.
So can you just, for those who, since we're like Patrick's using terms like run on the bank and even referencing depressions, how does what's happening right now, in your estimation, looking at the banks and the banking system, how does it compare to what we saw during the financial crisis? Since I think for a lot of investors, since these percentage drops would be quite common to what we were seeing more than a decade ago, how would you compare what this means today versus what was happening then?
Yeah, from our perspective, for the banking sector specifically, this is nowhere near as disastrous as what we saw during the financial crisis. Because what we saw in the financial crisis was it was the financial sector that was actually leading the downturn in terms of the fact of the matter was that poor risk management gummed up the system and caused no end of problems in terms of lending, viability of the banks in the U.S. All started by poor mortgage lending practices. This time around, the concern really is economic slowdown. What's going to happen to GDP growth? But it's not necessarily the banks are the ones that are causing the problems. Now, there's obviously broad implications for the banks, thus why the share prices are down. But the banks are not the cause of it this time around. And to be honest with you, that gives us a bit of relief in context.
Well, it's helpful context for people who are watching these stock drops, and to many people, these just don't make sense. Now, I've said it a couple of times, and Patrick Horn said it as well this morning. I mean, this is the real-time measurement of panic and fear. Whether this is just worry about businesses and economies and the valuations of stock prices, I think you could easily go further than that. People are seeing all the headlines surrounding COVID-19 and the worries surrounding that, and that's ultimately being reflected in stock trading right now. I mean, the idea of whether or not, because Patrick brought this up, I mean, do we need a timeout? We're taking trading halts, circuit breakers are kicking in, but if businesses are shutting down right now and people are being urged to stay home, should there be a conversation around whether or not stock trading should be happening at this very moment, John?
Yeah, I mean, you're talking now more in terms of a macro strategist, and I'm a humble bank analyst. But to your point, absolutely, where the reaction that we're seeing today in the market broadly, but in my sector specifically, is we just don't know. Yeah. And so when there's that level of uncertainty, when you can't run numbers with any degree of probability, you start going, okay, well, how conservative can I go? What does this mean for earnings? What does this mean for the outlook? And you're seeing what's being priced in. Unfortunately, the moves by the central banks were done to try to bolster confidence. This has not happened. So we're in a bit of a free fall at this stage in the game.
All right. Now, since we've been talking a lot about the Canadian banks and looking at our screen declines of more than 12%, I just want to remind our audience what has happened so far in another very eventful morning here at BNN Bloomberg. We saw a trading halt right out the gate today because we dropped 7%. Now, looking at our screen right now, the TSX is currently down more than 12%. The significance is that these circuit breakers, and we've gotten a crash course lesson in how they work over the last couple of weeks here, you'll see a trading halt if out the gate you're down 7%. You stop trading for 15 minutes. That's exactly what we did, and then we got back to business. But if you get down 13% in the markets, generally speaking, we see those circuit breakers kick in again. We haven't quite seen that play out, but in terms of percentages, I mean, we were already talking on Thursday about a record slide for the TSX, and in that case, we were down 12.3%, John. So, I mean, I guess we're in a record-setting mood here to the downside right now. I want to talk a little bit more about banks and their specific exposure to industries. You know, the conversation leading into today probably would have been, and you were kind enough to talk with us about their exposure to the energy sector, and certainly they've made some prudent moves over the last few years on that front. But we keep hearing about all the struggles for retailers who are closing their doors. We hear about the struggles for the airlines. A lot of people wondering about whether some of those companies are now going into survival mode. I mean, if certain industries have to make some tough decisions going forward, if we start talking about, you know, those worst case scenarios for any of those hard hit businesses, what does that mean for the banks in terms of their exposure to any one industry?
Yeah, so all else being equal, with no extraordinary measures being undertaken by the government, what you're going to likely see is some pressure on these businesses, potential bankruptcies, and then loan losses for the banks. And as you run down, I mean, as you listed off, there's a whole host of sectors that right now could feel a lot of pressure. You mentioned energy, retail. We could be looking at airlines, potentially manufacturing. What are supply chains going through? But broadly speaking, if you're going to take a look at the Canadian banks in context, what's most likely going to deteriorate first is their commercial lending, their business lending, not their personal lending at this stage in the game. So in context, when we look at the banks that have greater exposure to this, Bank of Montreal sticks out because it's taken a very concerted strategy to focus on commercial lending, because that's over the last 3 years where the growth had been larger profitability in terms of higher interest rates being charged. But they're the ones now that are sticking out as being most at risk. When you take a flip side and say, okay, well, who's least exposed? You look at TD and Royal Bank because of the large personal lending portfolio. But when we're trying to figure out exactly who's going to get hit worst based on their specific exposures, it's very difficult at this stage in the game, which is why investors are taking a broad stroke. Okay, I'll assume X% losses.
All right, John, really good to get your insight and analysis again. Thanks very much. Busy day for you as well. John Aiken of Barclays joining us with more on the Canadian banks.